Hello everyone, welcome to the 165th episode of me learning how to trade in Forex. So in the last episode, we finished going through the creating a trading plan lesson. Basically, a trading plan is a useful decision making tool that helps you decide what, when and how much to trade. So we looked at what we should consider when creating a trading plan. So why do I need a trading plan in the first place? Trading plan can help you make logical decisions and decide on the framework that will define your ideal trades. So the idea is to use your plan to help you avoid making any emotional decisions that can mess up your trade. So implementing a trading plan is one of the best ways to practice trading discipline and to learn what works and what doesn't, as well as figure out how to improve your trading performance. So then we've got a list of things that we should put into our trading plan. So your motivation for trading and your goals, time commitments, trading strategy, your risk appetite, how much capital you want to trade with, which markets you plan to trade, and how you'll manage the record keeping. So one of the best ways to test your trading plan is use it in your demo trading account. And then we got setting our trading goals. So trading goals should be SMART, so specific, measurable, attainable, relevant, and time-bound. So not every goal has to be based on monetary results. So first goal might be follow your trading plan for 10 trades before making adjustments to it. So another goal might be only to make the trades that meet the requirements you've set on your trading plan. So traders can set monetary goals and then push too hard to achieve them. So even when the market doesn't suit their example parameters, right? So it's easy to make tempted to make impulsive trades that doesn't quite fit in with your strategy. So one of our goals could be to stay disciplined by sticking to our trading plan. And then we looked at the risk rate of return and the risk reward ratio and how that could fit into our trading plan. And then we went through a lesson summary. So now, to finish off the the tools for traders lessons, we're going to finish off with the quiz. So the reasons traders might consider using a demo account is practice trading a simulated live environment without putting any capital risk. Yep. Test new trading strategies. Yep. Try out trading in new or different markets. Yep. Improve trading performance. Yep. So all of them. True or false? The best way to prepare for a live environment with a demo trading account is to try trading as many markets as possible with the highest amount of virtual currency. False. When it comes to trying out a trading strategy, which of the following should you avoid if you're interested in short-term fast trades? Should you avoid? So position and swing. Wait, which are position? I was going to click on position and swing, but position? True or false? Hedging refers to making a trade with the intention of reducing the risk of adverse price movements in another asset. True. Which of the following are common mistakes that novice traders make? Over-reliance on gut feel, intuition, holding on to losing positions, and not understanding leverage. I guess all of the above. True or false? Successful trading in demo environment guarantees success with a live trading account. False. True or false? The best way to develop a trading plan is to copy someone else's exactly. False. Most traders aim for a risk-reward ratio of 1 to 3 or higher. Relative strength index is considered. Right, okay. So I know it's 30 and 70. Oversold when it's above 70. Overbought when it's below 30. Let's go with that one. I forgot which way around it is. Which of the following is a useful method to keep track of historical data not stored on the trading platform that includes important psychological aspects? Keeping a detailed trading diary. 90, okay, so the reasons traders might consider using a demo trading account is demo trading account might benefit traders wherever they are in their trading journey. This could be learning how to trade from scratch using virtual funds and therefore not risking any real financial loss. Trialing new trading strategies, moving into new markets, or looking to pinpoint persistent poor trading decisions to improve on them. If you're using a demo account as a learning tool to prepare you for the live trading environment, Market analysis suggests treating the demo account as realistically as possible. They also recommend focusing on the key markets you're interested in and setting your trading capital at the amount you plan to trade with on setting your trading capital at the amount you plan to trade with on a live account. Right. So position trading occurs when the trader holds the position for long periods of time, disregarding small price fluctuations and aiming to profit from long-term trends. Hedging is when you make an investment or trade to reduce your existing exposure to risk. Most hedges involve taking a position that offsets one or more open positions, such as a futures contract that sells stock you've bought. A common mistake that novice traders make. All of the above are common mistakes that beginner or intermediate traders tend to make. Intuition takes time and experience to hone, so for novice traders, it's important to check feelings or tips against evidence and market research before committing to opening or closing a position. Failing to cut your losses early is another common error that can wipe out profits you might have made. The first step to avoid this pitfall is to stick to your trading plan. Finally, many traders found themselves experiencing far bigger losses than they knew were possible because they didn't have a grasp on how leveraged products work, such as spread betting or CFD trading. So, while demo trading provides valuable practice for the live trading, there's no guarantee of success in the live environment. The heightened emotional aspects of live trading, along with real market conditions, can affect performance. While examining someone else's trading plan can help in developing your own, you always need to reflect your individual motivations, the time you plan to spend trading, the asset classes you want to trade, the strategies you tend to implement, your risk appetite, your available capital for trading, and how you plan to keep records. The best way to develop a trading plan is to therefore tailor it to your own specific needs and parameters. So many traders aim for a risk-reward ratio of 1 to 3 or higher. This means the potential profit you can make on a trade will be at least triple the potential loss. Okay. So, traditionally, relative strength index is considered overbought when it's above 70 and oversold when it's below 30. This indicator is used in technical analysis to assess the momentum of assets to gauge whether they're in overbought or oversold territory, and runs on a scale of 0 to 100. So while there are many useful metrics you can track to improve your trading performance, including win rates, profit-loss ratio, and total return, none of them capture the emotional and psychological aspects of the trades you make. Discipline is one of the keys to trading success, which requires mastering your emotions. Keep track of what you were thinking and feeling as you made a trade. It's advised that you keep a detailed trading journal. Nice. So, that was the tools for traders lesson done. Creating trade plan, yep. Very nice. So finished off all the beginner courses, now we can move on to the intermediate ones. The basics of technical analysis. The basics of technical analysis. Technical analysis can help you make sense of the way investors' behavior drives the market prices. In this course, we show you how to start using charts to forecast which way a market might move, helping you spot potential trading opportunities. You get to know the different types of chart available and how they work, and you'll learn to identify some key chart patterns and understand their implications. We'll also introduce you to some of the most popular technical indicators, tools you can use to derive trading signals from market price data, and show you how to apply them. Nice. So, introduction to technical analysis then. Introduction to technical analysis. Date is the 13th. Market analysis is an essential part of any trading strategy. It involves using the information available to you now to make educated predictions as to how a market will behave in the future. So, a market analysis is an essential part. Involves. There are two main types of market analysis: technical, fundamental. Two main types of market analysis. So, wait, let's just write definition. Market analysis involves using the information available to you now. Using the information available to you now to make educated predictions as to how the market will behave in the future. Two main types of market analysis: technical, fundamental. So, technical analysis. Technical analysis focuses exclusively on the price movement of a market, while fundamental analysis looks at the wider economic factors that can affect its price. So focuses exclusively on the price movements of a market. Fundamental analysis looks at the wider economic factors that can affect this price. Looks at the wider economic factors that can affect this price. You'll often find traders identifying themselves as either technical or fundamental analysts, extolling the benefits of one over the other, though ultimately a grasp of both forms of analysis will give you the best platform to trade the financial markets. In this course, we'll be focusing exclusively on technical analysis. What is technical analysis? Technical analysis is based on the premise that what happens in the past can be used to predict what might happen in the future. So technical analysis is based on the premise that what happens in the past can be used to predict what might happen in the future. Although of course you have to remember this can never be guaranteed, which means technical analysis shouldn't be used in isolation. However, remember that this can't be guaranteed. So technical analysis shouldn't be used in isolation. Technical analysis is what traders use to study the historic price movements of markets, and by far the easiest way to do this is by looking at charts. By examining the trends and patterns in market prices, technical analysts can interpret the behavior of buyers and sellers to help give an indication of where the market could go next. By examining the trends and patterns in market prices, technical analysts can interpret the behavior of buyers and sellers to help give an indication of where the market could go next. Since there are certain types of behavioral patterns that have occurred repeatedly in the past, it's possible to identify them as they emerge and predict the likely future movement of the market. For example, if the share price of big pharmaceutical company EFG keeps dropping at around 100 pence level and then rising immediately afterwards, a technical analyst might choose to buy some shares the next time it falls to that price, predicting that the pattern will repeat itself. In the technical analysis world, the 100p level is called a support level. We'll study support levels and other patterns in more detail later in this course, but before we do that, in the next section, we'll take a quick look at the three main types of charts you can use to analyze financial markets. So let's do summary. There are two main types of market analysis, technical and fundamental. Technical analysts say what happens in the past can be used to predict what might happen in the future. By studying trends and patterns in market prices, technical analysts forecast which way the market might move next. Type of charts. So, the first thing you need to understand as a technical analyst is the different types of charts at your disposal and their relative benefits. Charts come in three main forms: line, bar, and candlestick. Let's have a look at each type. Let's have a look at how each type works. So there are three main types of charts: line, bar, and candlestick. Line charts. This is the simplest form of chart, essentially just a number of data points joined by a line. A number of data points joined by a line. This type of chart shows the historical price movement of an asset in a very clear and simplistic manner. This type of chart shows the historical price movements of an asset in a very clear and simplistic manner. In a very clear and simplistic manner. So it looks like unlike their bar and candlestick cousins, line charts only display the closing price of an asset over time. Line charts only display the closing price of an asset over time. So if we look at the daily chart for spot gold, for example, each data point represents the closing price for gold on that day. The benefits of using line charts is that they can make patterns easier to spot. However, due to their simplicity, you can miss some of the important price movements that occur between the open and close of each data point. Line charts can make patterns easier to spot. However, you can miss some of the important price movements that occur between the opening and closing of each data point. Bar chart, also called HLOC charts. More complex than line charts, bar charts show the opening and closing prices as well as the highs and lows for each period. Bar chart shows the highs and lows, shows the opening and closing prices as well as the highs and lows for each period. That's why they're sometimes called HLOC. Oh, high, low, open, close, because they display the high, low, open, close. Alright, okay. Also known as LOC, high, low, open, close. Do that, boom, boom, boom. The very top of each bar represents the highest price traded during that period, while the bottom signifies the lowest. The horizontal notch to the left is the opening price and the notch to the right is the closing price. Often bar charts are in black and white, but they can also be displayed in colour, as shown on this 5-minute chart of the FTSE 100. In this case, the red bars represent a 5-minute period where the price has dropped, while the green bars represent a 5-minute period where the price has risen. Risen, dropped, dropped, risen, dropped, dropped. So, I want to say, look at get a bigger picture of this. So let's just open this up. So, do that. So, green, top, high, low, open is to the left, open, close. So it's closed higher than it's open, which means the price has gone up, right? And it opens here, closed above where it's open, so the price gone up. Opened here, closed where it's open, gone up. Opened here, but it's closed below where it's open, so the price has gone down. Opened here, closed here, price gone up. Opened here, closed here, price has gone down because it closed below the open price. So on. Right, okay, I see. Bar charts are usually in black and white. However, they can be displayed in color. Red bars represent a drop in price. Red bars represent the price dropping, and green bars representing the price rising. Candlestick charts. These show exactly the same data as bar charts, but represent the information slightly differently. Here, the body of the candle signifies the open to close range, while the wick is the high-low range, and the colour displays whether the price has gone up or down. Traditionally, candlestick charts were always shown in black and white, but most charting platforms now use red and green instead. Shows the same information as bar charts, but represents them in a slightly different way. So like that. A red or black body signifies a period in which the price has decreased. A green or white body signifies a period in which the price has increased. Yep. So increasing candlestick, closing above the opening. Decreasing candlestick, closing below the opening. Highs and lows are the same, so top and bottom wick on both the candles. Candlesticks are generally the most popular type of chart for traders, as they are able to convey a large amount of data quickly in a visually pleasing and easily digestible format. Certain patterns also tend to be easier to spot on a candlestick chart compared to a line or bar chart. Looking at the same 5-minute FTSE chart, it's arguably easier to distinguish the market movement and trends on the candlestick chart than on the bar chart. Yeah, I guess, yeah. The shape of each candlestick can also give you clues as to the balance between buying and selling pressure in the market. So, the shape of the candlestick can give you clues as to the balance between buying and selling pressure in the market. For example, if a candlestick has a long green body, it shows there's a lot of buying pressure. If it has a long red body, there's considerable selling pressure. So candlesticks with long green body show significant buying pressure, right? Lot buying pressure. Candles with a long body show lots of buying pressure. Candlesticks with long red body shows lots of selling pressure. So green candles, closing price is really high above the opening price, so that means the prices increased very quickly, right? So if the price is being increasing very quickly, that means, using supply and demand terms, there's not enough supply to cope with the demand, so the price increases. Therefore, if there's not enough supply to deal with the demand, that means there's a lot of buying pressure. With the red candlesticks, same principle. Closing price is really below the opening price. Yep. So if the closing price is really below the opening price, that means there's not many people buying it, right? So there's going to be more demand than supply. If there's more demand than supply, the price falls. And if the price falls, nobody's buying it, and there's more supply than demand, that means everybody's trying to sell it instead. So, yeah, that shows a lot of selling pressure. Yeah, okay. Candlesticks with short bodies and long wicks indicate that there was a considerable pressure in the one direction, but for some reason the price was pushed back before the end of that period. So candlesticks with short bodies and long wicks show that there was considerable pressure in one direction, but for some reason the price was pushed back before the end of that period. We'll look in more detail at the candlestick patterns later in this course. Right, okay, so same logic, green candle, closing price above the opening price, closing price above the opening price. So the closing price and the opening price are really close together. However, we've got the highs and lows, so high, low. Highs at the top, lows at the bottom. What does that mean? That means, so let me just rethink. Closing, open, right? Okay, opens here, lows here, closings here, highs here, right? Okay. So the opening price is really far away from the low, from the lowest price in that period, and the closing price is really close to the highest price in that period. Because you say that there was considerable selling pressure because the price was dropped really low, below the opening price, like in this case. Oh no, not in this case actually, no. So it's dropped really low below the opening price, and it somehow managed to go back up again. So reverse, above the opening price. Whereas this one, this is where the opening price is above the closing price. So the closing price managed to go really high above the opening price, but then it reversed and dropped below the opening price. So it could have risen in value. Oh no, the price could have increased, but it didn't. Instead it decreased. Whereas the green one is, the price could have decreased, but it didn't. Instead it increased. So that's the best explanation I could come up with, to be honest. There are three main types of charts: line, bar, and candlestick. Line charts just display the closing price of an asset over time. Bar or high-low open close shows the high, low, open and close prices for each period. For candlestick charts, the body of the candle signifies the range between the open and close. The wick is a high-low range, and the color displays whether the price has gone up or down. A green or white body shows the price has increased, whilst a black or red or black body shows that it has dropped. Long candle bodies and short wicks signify that there's been strong buying or selling pressure in one direction. Short bodies and long wicks indicate that there's significant buying or selling pressure in one direction, but that pressure then reversed. Support and resistance. So support and resistance. Support and resistance are the building blocks of technical analysis, and many effective trading strategies that can be based solely around them. In simple terms, support and resistance are like glass floors and ceilings which appear to limit a market's range of movements. So, support and resistance appear to limit a market's range of movement. The reasons these levels appear is due to the balance between buyers and sellers. So support, oh my god, support and resistance appear due to the balance between buyers and sellers, or demand and supply, So the buyers are the demand, sellers are the supply. When there are more buyers than sellers in the market, or more demand than supply, the price tends to rise. And when there are more sellers than buyers, or more supply than demand, the price tends to fall. So there are more supply than demand, so more sellers than buyers, the price tends to fall. If there are more demand than supply, more buyers than sellers, the price tends to rise. Support and resistance are the turning points. For example, a support level occurs when a market that's falling halts its decline to move higher. A support level occurs when a market that's falling halts its decline to move higher. This typically means that the balance of the market participants is moving from a seller's market to a buyer's market. The low point of the move is seen as a level support. So support and resistance are turning points. Resistance is the opposite. It's a level where the rising price reverses downward as a shift in the balance of buyers to sellers pushes price lower. The high point is a resistance level. A support level occurs as the balance of market participants move from a seller's market to a buyer's market. A resistance level occurs as the balance of market participants move from a buyer's market to a seller's market. The lines marked 1 and 2 below each represent a support or resistance level. Which is which? 1 is resistance, 2 is support. Resistance is the ceiling that the price struggles to break through. Supports the floor where the price tends to stop declining. Finding support and resistance. Areas of support and resistance are relatively straightforward to plot on a chart. You just need to find a level where the market has reached but not being able to break through. So support and resistance can be found on a chart from levels where the market has reached but not broken through. The more times the market reaches that level but fails to go through it, the stronger that level of support or resistance is said to be. The more times the market reaches that level and fails to break through it, the stronger that support or resistance level is said to be. Or resistance. In fact, major levels of support and resistance can often become psychological barriers. Major levels of support and resistance can become psychological barriers, with many traders buying or selling as soon as that level is reached, which serves to reinforce the effect. As many sellers, many buyers, many traders selling or buying as soon as that level is reached, which serves to reinforce the effect. It's important to note that major support and resistance levels are rarely exact figures. Major support and resistance level are rarely exact figures. It's unusual for a market to hit exactly the same price time after time before reversing. It's unusual for the market to hit exactly the same price time after time before reversing. So it's probably more useful to think of them as support or resistance zones. So it's more useful to think of support and resistance zones. So we've got strong support because it's hidden here 1, 2, 3 times and it still hasn't broken through. Minor resistance, this is all minor apparently. This is minor as well, minor support. How would you classify between minor and stronger? Oh, this is like mini ones, so this is like the baseline, the base one. This is the ceiling, the very high ceiling. These are just like in between support and resistances. So the price hasn't actually gone through this bit yet. So these are the minor support and resistances. So it will go here, 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 and then it won't pop up above that one, break through that one. It will just keep bouncing between these two major support and resistances. So these are the small ones which happen in between the small support and resistance levels. As you can see in the chart above, the market often goes past or stops short of each support or resistance line, no matter how strong they appear to be. When a market touches or jumps through a support or resistance briefly before reversing, it's said to be testing the level. So the market said to be testing a level, said to be testing the support and resistance level when it touches or jumps through it briefly before reversing. The market can often go past, stops short of each support or resistance line, no matter how strong they appear to be. So let's in summary, support is like a glass floor and resistance is like a glass ceiling that restricts a market's price movements. They are not exact levels but more price zones. When a market price reaches a support or resistance level but doesn't break through, it's said to be testing the level. I'm going to leave this episode here then. So in the next episode we're going to go through breakouts and fakeouts. So thank you all for watching and I shall see you guys in the next video. Peace.